pretty commonplace to believe that who you choose to work with is super important. From an auto mechanic you trust not to overcharge you, to a medical professional who takes the time to listen rather than 15-minute timer, starting the minute they walk into your room to talk to you. And if you're picky with your car repairs and your physical health, shouldn't you be just as picky with your financial partners? Hello, and welcome to the Wealth Wisdom Financial Podcast. We believe when conventional financial thinking doesn't get you where you want to go, you need wealth wisdom. Please hit that subscribe button so you never miss an episode. And if you're watching on YouTube, we would love for you to like this video and comment below. If you got a story about an auto mechanic or a doctor or some other professional that you learned not to trust, I love to hear that. I've had too many of them, I feel like. Now, we're in a series where we're talking about Bank on Yourself. And if you missed our last episode, we discussed who uses Bank on Yourself, and we recommend going back to that. Today, we're going to talk about how you can tell if you're working with the right person, the right company, when looking for a properly designed Bank on Yourself type whole life policy. And right is in air quotes there. We'll talk about what right means. We're not talking about morally right or anything like that. We're just talking about a good fit for you and what you're working on. So in case you're just joining our podcast, Bank on Yourself is a quote, safe wealth building method to achieve lifelong financial security, end quote. That is a quote from Pamela Yellen, the creator of the registered trademark Bank on Yourself. And that trademark is owned by the Hayward Yellen 100 Ltd partnership. That partnership maintains the website bankonyourself.com. This video has not been reviewed or approved by Pamela or anyone else at Bank on Yourself. What you're about to hear are my authentic thoughts and feelings about what Bank on Yourself is to me, what I think about when it comes to who you work with to do Bank on Yourself. Now, for the nerds out there, I want to let you in on a really awesome resource. A friend of ours, Mark Willis, host of the Not Your Average Financial Podcast, put together a comprehensive list of 20, almost 30 different criteria of what it takes to have a true Bank on Yourself type whole life policy. We're going to put a link in the show notes of this episode so that you can go check out his episode and the full list that he has there. Use it for reference, all those kind of things. For you, what I want to give you in this episode on our show is a thing to just sit back, listen, watch. We're going to share some of the details of who you work with, both the financial professional and the insurance company. They are actually intertwined a little. So I'm going to kind of go back and forth. We're going to talk about the professional you choose to work with, and then the insurance company, and then back to the professional. Both are super important. So listen carefully, and of course, follow up with your Bank on Yourself professional with questions. So here we go. First, whatever financial professional you work with, there's one major thing that is a super big deal to me. It's that they have the opportunity to match you with the best, quote unquote, best insurance company and product within that company to fit your needs, which means best is going to look differently for different people. In technical speak, they are a broker rather than a captive agent. They work with multiple companies rather than being tied to one company. Now, that's important because different companies have different strengths that can be matched with your specific situation. The strongest company for you might be different from the strongest company for your parent or your child or your neighbor, your coworker. So you might want to start to intuit that if you need a broker that can work with multiple companies, that there are multiple companies that work for a properly designed Bank on Yourself type whole life policy. One no-brainer is that they have to offer whole life insurance. Okay, check mark. Hopefully we got that. You might have also heard these other common criteria that are often discussed. First, they have to be mutually owned life insurance companies, not stock owned. The big difference is when a company is stock owned, they have to put their stockholders first. With a mutual ownership company, the policyholders are the owners, and the owners get first priority in the decisions of that company. So the policyholders get first priority for the decisions and that are made within that life insurance company. One thing that's I often hear from people is using that they when they talk about the life insurance company. Well, they need to make money. They need to, do X, Y, or Z. They have to make these decisions, do that kind of thing. And I'm like, who's they? In a mutual life insurance company, the policy owners are the they. So if you're thinking, well, how do they make money? It's actually how do the policyholders make money comes first. Okay. Secondly, they have to have strong third-party independent ratings. There are these rating companies out there that rate life insurance companies, and we want to have strong third-party ratings. Some of them are like A plus, A minus. Other times it's a score out of 100. You want to look for those third-party ratings. Then the third thing is for a true bank on yourself type whole life policy, you want to work with a company that has paid dividends every single year for over 100 years. They have that track record of being profitable and doing what's right by their policyholders. And if you think about it, over the last 100 years, there's been the Great Depression, there's been a world war, there's been high inflation, low inflation, some deflation in there. There's been stock market lows, stock market highs all over the place. The whole idea behind this is you worked with a company that has been profitable through all of those. And then the fourth one comes to when you want to use your policy to do the things of life. And you are going to go buy a car, you're going to put a down payment on a house, you're going to pay off debt, you're going to use retirement income, whatever it might be. You want to make sure that when you are utilizing the policy to do those things, that your dividends and your guaranteed growth are not being impacted. You get the same dividends whether you take a policy loan or not. You get the same guaranteed growth whether you take a policy loan or not. Very big deal there. The technical term there is non-direct recognition, as opposed to direct recognition, where when you take a policy loan, your dividends are decreased or held. You don't see the same growth as if you did not take a policy loan. Now, we could probably do a whole episode about that. If you want to hear us do the debate, direct recognition versus non-direct recognition, let me know in the comments on YouTube if that's a video you want us to make. So those are like the four that are often talked about. I want to add 5 more to that list. First of all, I want a company that has good customer service. When I want to take loans, make premium updates, if I'm accidentally send them too much money, I want them to alert me that I could make the policy a modified endowment contract if I pay this extra premium that I wanted to, all of those kind of things. I want to have good customer service from just the team at the life insurance company. Secondly, I want a company that offers me paid up additions riders where I can overfund the policy, add to those paid up additions as premium, not just with my dividends. And I want to make sure that when I do that, that there's reasonable load cost, there's not too much load cost, which is like the fee charged when you add to your paid up additions. And I have flexibility. I can add more or less to my paid up additions within reason, right? I want to know that flexibility works for me. For some companies, it might be 25% or 10%. For others, it can be a lot larger. As a self-employed person, I like the larger flexibility companies because my income fluctuates. Whereas somebody who has a stable job, they might be more comfortable with less flexibility, right? Third, I want to know not just their 100-year of paying dividends, but their most recent dividend history. Personally, I like to not focus on the percentage, what's the percentage of dividends they paid, but instead I like to focus on, are the dividends steady? Have they been increasing or decreasing lately? What does that mean in terms of how their portfolio is working? Those kind of things. So in addition to seeing that they've paid dividends at least for 100 years, I like to look at the last 4 or 5 years, maybe 10 years of dividends and see how they've been moving. Then fourth, we talked about non-direct recognition. When you take a policy loan, you get the same growth of your policy, regardless of whether you take a loan. I also want to know how much interest is charged and when. Policy loan interest rates, super important, but also are they charged at the beginning of the year or the end of the year? That can make a big difference in terms of how much I end up paying for that policy loan. And then finally, the fifth one, when it comes to the life insurance company and the products that they offer and all their terms of services and all of that, is on the guaranteed side. So yeah, I want the company who has the strong independent ratings. I want to see they've backed up their guarantees and their dividends for 100 years, but I also want to know how much of my cash value is guaranteed. There's a fancy name for this. I don't need to bore you with it. But it's basically, if I look at my cash value in say 20 years, how much of that cash value is guaranteed to be there? And how much is based on the dividends that have been paid, which can fluctuate each year. And this is actually, a lot of people talk about how do you compare this policy versus that policy? How do you decide which one you're going to use? In addition to all these criteria, this percentage guaranteed versus percentage that's coming from dividends is a great way to compare policies rather than just looking at the cash value or the death benefit or the cost per thousand of death benefit. We can talk about customer service, paid up additions, how much are available, how much does it cost to add them. But end of the day, I'm doing Bank on Yourself because I want guarantees. And so I want to see what that guarantee looks like. Okay. So that's one that doesn't get a lot of talk out there, but I'm hearing people talk about it more and more, and I want to put that out there more and more. It's a very important part of the types of policies that we use. So that was my laundry list, 9 things of the company. Now let's go back to the professional. Does the professional know the answers to all these questions? When you look at the policy, can they talk about the customer service at the company? Can they talk about the independent ratings? Can they talk about the load fee on the paid up additions? Can they help you determine how much of your cash value is guaranteed in 20 years versus with dividends? Can they help you evaluate your options and explain quickly the pros and cons of a couple different scenarios that you might be thinking about? And are they even willing to give you as unbiased an evaluation as possible? I mean, are they willing to take what they're proposing and maybe another option that you're thinking about, put them side by side and tell you pros of the other option and cons of the other option and pros of your option and cons of that? If that's what you need to move forward, are they willing and able to do that? Which leads to accountability and continued education. There is state required continuing education for financial professionals, but also how else are they staying up to date on industry trends and the options available to you? Bank on Yourself has regular mastermind calls. I go to 3 or 4 of them per month to continue learning. They also provide a coach, a mentor, a whole team to support the Bank on Yourself professional to answer questions, make sure they're getting the clients what they need and putting the clients in the highest priority, not their own commissions or other things like that. So that kind of support behind the Bank on Yourself professional, which actually leads me to what happens if the professional you work with is no longer available. They get hit by the proverbial bus crossing the street one day. Let's use me as an example. I get hit by the proverbial bus. What happens? Well, one of the things that brings me a lot of peace is knowing that there's a team of 200 or so Bank on Yourself professionals around the US and Canada that will provide the same service as me, my husband, my mentor, my coach, the people that I work with in the day-to-day of my business. If all of us were walking down the street at the same time when the proverbial bus loses control and takes us out, there's 200, very unlikely that all of us would be hit by that same bus. And so that gives me a lot of peace to know that no matter what happens, no matter what the future holds, my clients are going to be well taken care of, well serviced on their financial journeys. Now, I get it. Everything I just shared is a lot to consider. One of the common objections is that there's this big learning curve to feel ready to evaluate one type of policy compared to another, one type of agent compared to another, one type of company compared to another. Who has time to evaluate all the options and feel 100% confident before moving forward? That's actually one of my favorite aspects of being a bank and yourself professional. I get to think about these topics 40 plus hours a week. Honestly, I probably think about it too much. I have dreams about it. I believe I should always know more about whole life insurance than my clients. There's no way that the doctors, the real estate investors, the nurses, the stay-at-home moms, the plethora of different kinds of people I get to work with, there's no way that they can invest the same amount of time that I have evaluating everything that I can. But I do want them to feel confident and comfortable about moving forward. So I love to take what I've learned and share as much as they want to know to help them feel comfortable. To me, the very worst thing is to work with someone who is not willing to take the time to help you learn and evaluate. I actually like to call it learn and confirm because it's got a little bit of like rhyming to it. Learn and confirm, learn and confirm. I've come across too many people who work with financial professionals from across the industry who talk above their heads or just show them one option without taking the time to make sure it's the option for them based on them, the resources they have available, and their goals for the future. A few months or years later, the professional might not even be there, often isn't there to help that client mitigate a change or figure out how to pay premiums or any number of things. So here's a great way, a litmus test, if you will, to help you tell if you have a true professional and a company that works for a true bank and yourself type policy. You ready for this? If you're taking notes, write this down. If you're driving, commit this one to memory. It's really easy. Here's my litmus test. Ask what if. Ask what if, and then fill in whatever comes to mind after that. Think of a few worst case scenarios and see what happens when you ask about them. Can the professional answer? Is your policy able to flex and bend and help actually stay active? Do any of the guarantees go away? See how you feel about those answers. Ask, what if? What if I lose my job and can't pay the premiums? What if I want to just lower the premiums? What if I want to increase the premiums? What options are available? Ask what if. What happens if you get hit by a bus? Ask it. Why not? So to conclude, I want to share something that might seem a little counterintuitive, okay? Beware of financial professionals who are not fully trained regarding bank and yourself type whole life policies. I'm not just saying that because I am, fully trained. I'm saying that because there's a lot of misconceptions out there that just aren't true, or they're generally true, but they're not true specifically. Let me tell you what I mean. Not a whole life is the same. What might be true of one policy isn't true of all policies. What might be true of 90% of policies might not be true for the other 10%. What one person may understand about whole life might be true in general, but it might not be true for the type of policies used for bank and yourself. I'm not telling you not to do your research. I'm telling you to be very careful who and what you believe. So take this example. Let's say you're experiencing some weird physical health symptoms. You might go to WebMD and you might search, here's my symptoms, what could be wrong with me? And you might also go to a doctor. Hopefully you would also go to a doctor and ask them. And I've heard doctors, nurses complain about WebMD and people thinking they've got all these weird things when they really don't. But it's not that WebMD isn't true. It's just not true in your specific situation. So it's why we have doctors who can look at you and your specific situation, your age, your gender, your height, your weight, your blood results, all the things that are true for you, all the symptoms as you describe them to them, and they can make a diagnosis. They can provide treatments, medications, diet, exercise changes, those kind of things that are custom tailored to your specific situation. And you might ask them, hey, I read this on WebMD. What do you think about that? But you're hopefully going to trust the trusted doctor who's heard what's really happening with you and helping explain to you, here's why I'm making this recommendation. Here's why I'm saying this prescription or that diet change or those kind of things. So I believe the same is true with Banking Yourself. The info out there on the web might be true. The information that a financial advisor who focuses on stocks might tell you about whole life might be true in general, but it might not be true for your specific situation, for the specific type of policies we use for Banking Yourself, or for the Banking Yourself professional that you work with. So be sure to bring all those concerns to your Banking Yourself professional who knows your specific situation and hear their side, hear their case for why they made this proposal or why they chose this company or why they designed the policy the way that they did, and evaluate, based on your unique goals and concerns. I have a really hard time with any kind of blanket statements, and why we say at the end of every podcast, you want to work with professionals who know your specific situation. So, are you ready to learn and confirm if Banking Yourself is right for you? There's only really one way to do it, and it's to connect with the Banking Yourself professional. Now, one of the things you could do if you're not quite ready to jump into that conversation is we have a link for you that you can click in the show notes, where you can get a safe wealth building guide that shares some more information about what Banking Yourself is, why people do it, as well as the free chapter of Rescue Your Retirement. It's this book here, Rescue Your Retirement, five wealth killing traps of 401ks, IRAs, and Roth plans and how to avoid them. Really great book. It does talk about Banking Yourself, but not just Banking Yourself. So you might get this as a great financial literacy tool in general. So that's a great way to just learn more, begin to hear different things that you might not have heard before. And we'll also have a link in the show notes where you can schedule a 15-minute discovery call to ask some of your burning questions, right? You might not want to read a whole book or even a PDF, that Safe Wealth Building Guide, although it's like 24 pages, like with images and things like that, really easy. So do that, but also you might have like a really burning question you want to ask right now or as soon as possible. You can go to the link in the show notes. It's www.wealthwisdomfp.com/call, and you can schedule a quick call, 15 minutes, to ask that burning question and also talk about a little bit of what the process looks like to discover more, learn and confirm if Banking Yourself is right for you. So again, the link is in the description, but it's also super easy, www.wealthwisdomfp.com/call. Okay, that was a lot today, a lot of jargon in there. The number one thing to take away is don't believe everything you read on the internet and make sure you get something that's specific to your situation. Thanks for joining us. Hit that subscribe button and live long and profit. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation. Thanks, and we'll see you in the next episode.